Finding an affordable house in a high interest rate market. For many, it's a personal finance roadblock. How can we go around it or chisel through it? Melody Hobson, co-CEO and president of Ariel Investments and chair of Starbucks, says, "I love math because it doesn't have an opinion." Well, I'm going to show you 12 strategies, math and values-based tactics to get out of a housing holding pattern and into a home. So what are people doing if they're shut out in a high interest rate housing market? Some are staying in place, and this may be the smartest move, looking for constructive places to act on and plan their future. 529 contributions, maybe needing to move, vacations, renovations, and decorating, perhaps in what they might consider the wrong size suboptimal home. But some of these actions actually can grow ownership and net worth. But many renters are not so lucky. They're not building equity like the forced saving of money we get with a home ownership, and through a mortgage. Some folks are stuck renting, and if they did set aside money for a down payment, that money can be very fungible. It can move. And for a lot of us, if you got a big pot of money sitting around for a down payment, it's easy to dip into, especially if your housing goals are frozen or put on hold. You could put that down payment money in a CD, certificate of deposit, to get a good return and add a little friction, kind of a barrier to cashing out. Now, often, though, down payment money is just languishing and sitting around, let's say in a money fund or a savings account, even a checking account. But sometimes that can turn into spending when it really shouldn't. Now, examples include moving, paying off bills, vacations, weddings. And these funds, of course, are a juicy target if they are not purposed like in a sort of a lockbox. And as mortgage rates have increased, so have home prices. They have remained stubbornly high. And you're watching What's Next with Money, a program with smart insights to guide your financial decisions. Well, this housing gridlock effect means folks are not moving. There's decreasing mobility, and workers will not move that much to secure new and better jobs just because they can't get out of their house. They can't do that. Now, some can work remote. There really aren't any government incentives to encourage people to sell. The home sales capital gains rate exemption has not been indexed with inflation. And it's kind of been a selling deterrent. But policy thinkers are looking at incentives and maybe some alternatives. So here are those 12 strategies to get out of that housing holding pattern into a home or a different home. Number 1, assumable mortgages. Sellers can transfer to a lower rate mortgage with the house that they're buying. Now, if these programs existed more widely, then they could increase actually the price of the house offered. And some loans tied to government programs have this assumable feature. VA and FHA, in some cases, have assumable features. So check with your lender or realtor, but it's a good thing to look for. But let's say you take on the assumable loan. You find a house that comes with that. There's likely to be a large financial gap that is much higher than a down payment. So usually a second loan with a higher interest rate is needed. And your credit score comes into play here big time. Lenders can't make much money on assumable loans. So the economic and policy incentives here need tweaking. Tip number 2, asking sellers to subsidize interest rates for a few years. Say like 3 years for manageable payments to get you into that house. Now, this is hard to do considering the house price is higher. And this is known in the world of realty as a temporary mortgage buy down. Say 2% in the first year, 1% in the second or third year. Our third strategy is kind of another method like the previous one. This is called discount points. One discount point is 1% of the total loan value. And this can help reduce interest rates slightly, let's say by 0.25%. This discount point phenomenon is known as a permanent buy down, and new home builders often use this. Tip number 4. This is very common now. You got to move out of the area past most major cities for lower costs, more land and space, it's basically cheaper land, and a bigger home. Now, this can be good for remote work and in some cases, retirement. A consideration about moving just to get a different home or a better home is how close is the family and the extended family around the area. Number 5, assistance programs for down payment assistance for first-time home buyers. And there may be other home buyer assistance programs. You can check with your state finance authority and housing counseling. HUD authorizes housing counseling agencies, and we'll have a link to that. Number 6, seller financing. Now, the seller who's offering this nice home, probably free and clear of a mortgage from their point of view, they want income. And this is why they might be motivated to do seller financing. Basically, they become your bank. And this should be set up by an expert, a lawyer, and the loan recorded and enforceable. And then it may be just a short time. It might be to get through this high interest rate period. So the seller says, I want some income out of this. I don't need all the cash right now. So they're going to kind of be your mortgage holder. And after 3, 5, or maybe a 10-year period, then the buyer must go out in the market and get their own external financing. Now, this is a set of income payments for the seller. The seller receives. And the seller is still, in a lot of cases, need a place to live if they don't have one already. So there are some barriers to making this work out. The seller might be older and really want income, and as I said before, likely has the mortgage paid off. So if you're getting value from this video, be sure to hit that subscribe and smash that like button. This moves our content to more people, and we really appreciate you sharing it. Now, tip 7, buy the house if it is the right house. Now, number 7, I'm going out on a limb here. I'm basically saying if you find the perfect house and you've got really the financing for it, the down payment, but it may be a stretch, this may be the time to get an adjustable loan or use other designated funds if it's helpful, if you're planning to stay in the area a long time. I got coached by my wife to buy a place in Denver, even though I was pursuing 2 long-shot jobs in another part of the country. But you know what? She was right. And it was right for us to buy where we were. And I ended up having better career opportunities in Colorado, and buying was the right thing to do, even though it was a flat market here, and yet it was getting stabilized after a local housing recession. Tip number 8, and this transitions right from number 7 about stretching to buy that house, it is the adjustable rate mortgage. Now, you can hold this mortgage until the rates go down, then you can refinance into a fixed rate. Our big tip here, and I've lived this like 5 times, when you refinance into a fixed rate, hopefully a lower rate, always go with the lesser term. Say you have a 25 years left to pay on your mortgage. When you refinance to go to the new one, don't go back to 30, go to 25, 24, maybe even 20 if you can pull it off based on the numbers. And you might be able to be surprisingly effective because the rates are lower. But now times have changed since I've had an adjustable rate mortgage. Many of these adjustable rate mortgages are structured with a fixed initial interest period, say 3 to 7 years. The interests they're lower, but they're locked in. And then the rates will reset annually or every 6 months after that initial period. Now, if overall interest rates generally go down, you may still be paying the higher rate, and the decision to refinance may not be worth the extra fees. When I got an adjustable as a cushion to the higher home prices I encountered in Colorado, the rate of my adjustable could change by 1% each year, up or down, but it had an overall life of the loan cap of 5% growth or reduction. Now, for adjustables, ask a lot of questions and get expert and second opinions. Number 9, build a house or buy a new one. Builders are offering more incentives, sometimes locking in price. And here's a subdivision from a builder, all laid out, but they're providing sometimes their own financing. And this financing, because of the volume, can be offered maybe at lower cost. And you may end up getting paid at a lower interest rate, lower down payment, or lower cost of the home in a development that's coming out of the ground for waiting and putting up with area construction disruptions. New homes, the good news is they now account for 1/3 of the available open housing industry. Tip 10, get a fixer-upper, especially if the fix-ups can happen safely and thoughtfully while you're living there. Number 11, rent out all or part of the house. This can mean renting rooms if you can somehow morph your home into a duplex or make it a seasonal rental, bring in a boarder, and you can always look in the backyard or to the side or do a pop-up. Could you have an ADU, an accessory dwelling unit, or remodel the garage to make it habitable? And you can see our video on how to make money off your first house. And then number 12, be a strong buyer. This is the ability for you to get an inspection done at a home you're targeting fast and be prepared to live with the problems, if they're minor, that need addressing or getting fixed under your direction and management. Also means getting a pre-approval letter for financing, having a big down payment, and have your credit score in order and your financial and employment documents pulled together. In other words, you can act fast and efficiently. Always have an inspection done, but if the inspection raises too many red flags, that's not the time to buy that home in most cases. So there are the 12, but there is more to this housing holding pattern. We want you to be bold with your goals and intentions. Housing may or should not be your leading priority. When I moved to Colorado, housing costs were 40% higher than where I left. And get this, Colorado was already in a historic multi-year housing recession. So to ease into this housing price hike at this higher price point, we took out a 30-year adjustable. And then later we refinanced that to a 20-year fix when rates dropped. We refinanced again to a 12-year fix. You get the pattern. Always trying to build wealth, increasing the net worth, and lowering debt over time. But we bought those extra years by those lower interest rates. We later turned this first Colorado house into a rental, and then eventually paying it off, and later it was easy to borrow back from it to finance duplexes. And finally, I ended up on that first rental doing a 1031 tax-free like-kind exchange for more duplexes and the building of a business. Now, this housing journey involved me taking calculated, bold moves in depressed markets. But the initial relocation motive to Colorado was not real estate. It was to change and challenge myself and our family for job opportunities much bigger than housing. Although not planned, it all worked out to become a real estate development opportunity and a chance with a lot of training, a lot of classes, and then learning from experiences and experts to build a business. So we also have this phenomenon in the United States called the single-family homeownership inventory squeeze. And why is that the case? Well, the big issue in housing for many communities are national companies buying and converting single-family homes off the market into rentals. In Charlotte, North Carolina, in 2022, 17% of the single-family home purchases are cash buyers from these national companies. Some of these companies are traded on Wall Street. They're public companies, others are private. Local governments are considering annual fees for these larger firms if they buy a single-family home and convert that to a rental that they manage of a $10,000 per year per rental to be paid by those national companies back to the city. The objective is to slow this single-family home supply of ownership eligible homes from being taken off the table, off the market, and turned into rentals. And now I just want to mention a quick thing about mortgages. The 30-year mortgage, this is a quick, interesting history. Mortgages used to be 10 years in length, and borrowers would have to take out a new mortgage to pay off the old one. Then in the U.S., the Great Depression hit in the 30s, and at one point, 10% of the homes across the country were in foreclosure. So changes had to happen, and with long-term government-backed financing. Thus, the 30-year mortgage was born, as was Fannie Mae, Freddie Mac, plus later, the GI Bill for VA loans. Now in Canada and Britain, the fixed rates of a mortgage loan only lasts a few years. Then it goes variable. In Germany, fixed rate mortgages are widespread, but in that country, refinancing is rare and it's not encouraged. Denmark is most like the US, but the down payments for a home in Denmark are bigger and the lending rules are stricter than the United States. So fixed rate mortgages are often called a one-sided bet. When inflation goes up, the lower fixed rate, the lender loses. If rates go down, the homeowner is incentivized then to refinance. And according to the New York Times in an article by Ben Castleman, then we have the divorce dilemma. Divorce is another challenge in one's financial life and with housing. Divorced or separated couples are forced to live sometimes separately in the same house because of housing affordability issues and gridlock. Now, check this out. Sometimes they have to resort to separate entrances, parking, split the utilities, insurance, taxes, appliances, even parts of appliances that might be walled off using different color tape, kids' schedules, and rooms. And then even the laundry is negotiated. You're talking about splitting expenses and duties. You know, it sounds like a setup for a sitcom, and sometimes it is. But usually a couple, in a normal divorce proceeding, a couple sells the house, splits the proceed after the mortgage is paid off, you know, what they come out free and clear, and then one spouse refinances the mortgage and buys out the other spouse and retains the house, or gets a completely new mortgage. Now, in some cases, joint or simultaneous moving to less expensive areas happens, and it may be the only housing separation options. So, finding affordable housing in a high interest rate market, you know, a prominent friend of mine says, I take no for vitamins. That's John Hope Bryan of Operation Hope. So you're getting a bunch of no's and you don't think it feels like vitamins. Think of the 12 strategies presented here and always get a second opinion. At What's Next with Money, we bring you financial insights and strategies plus what's happening or being contemplated in consumer policies to correct imbalances and failed markets. In this case, housing shortages. And we're always looking at future trends. This can be a searing financial moment or a roadblock you can overcome to build your financial muscle and resiliency. So be sure to hit that subscribe and that like button. And thanks for watching. I'm Brett Neiser, looking to see you next time on What's Next with Money. And check out this popular video, Close the Wealth Gap in Housing.